Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsarthi, and in this fortnight's podcast, we're going to talk about whether you should use GSEX to hedge against market volatility. In 2008 financial crisis, we saw that when the equity markets were turned extremely volatile, currency markets were volatile, the liquidity was very, very tight, and that corporate bond markets too were volatile. In all this, the safe haven was government bonds. The GSEC markets rallied, yields were fell sharply as investors rushed to safe haven assets to protect themselves against market volatility. So in 2023, now while there are no signs of a global financial market stress, but given that equities are record highs, interest rates are very high, with the Fed keeping rates at the highest levels in many decades. European EC central banks and other central banks keeping rates at high levels, all and with inflation rising very sharply, and now cooling off. And in India too, RBI has kept rates pretty high, largely in focus of inflation that was running at upwards of 7% a while ago. But now coming back to the conditions now, you have a case where inflation is cooling off. It could be from high base effect, but we can never be sure whether it's a long term solution. And equity markets too have been at record highs, and valuations have become more and more expensive as there's been record flows, capital flows coming into the country, and the rupee has been steady at a lower level against the dollar, at close to record lows against the US dollar. A lot of different signals in the market, and in all this, government bond deals, which have moved up since COVID from 6% levels, the 10 years moved up to around 7.5%, and now it's around 7.15%. Now, given that rates are at GSEC yields are at higher levels, now there is a feeling in the investors community that given that the market have reached such levels across all other markets, now is it a good time to invest in government bonds to one capture any kind of falling interest rates over the next 1.5 years as central banks look to ease uh, rates in the face of easing inflation, and also maybe that their past actions have had a cooling off effect on economies. And the second is that if there is a stress due to some factor or the other, then would G6 be a safe haven given that yields are at higher levels? Now, there are two ways to answer this question. But before that, if you're a financial advisor, the best place for you to invest in in bond markets, either in GSEX or in corporate bonds, is through INR Bonds Partner Portal. Take the most informed decisions to your clients with your best price discovery and the easiest of settlement process, all through the stock exchange. And there is no the settlement is as easy as just making a payment to the stock exchange for the bonds to come to your client's demat account on the same day or the next day. Log into INR Bonds Partner, become a partner, and transact. Give the best options, fixed income options for your clients through our partner portal. Back to whether GSECs are a good hedge against financial market stress. There is definitely a sense that GSEC at these levels of yields, and also the fact that going forward, that there could be some positive aspects in the for the government bonds. One is that obviously next year, as everyone knows, India's government bonds are included in the global emerging market index, bond index, so there will be good inflows. And the second is that government finances are looking very robust, and that so they could end this year with a good sticking to budget estimates on the fiscal deficit. But next budget year, they will definitely look to much lower the fiscal deficit sharply, given the robust financials of the government and that the economy is firing on all cylinders. Also, the fact that RBI recently has come out with a note on unsecured loans where they have increased the risk weights, capital for unsecured loans, personal loans, and unsecured loans for lenders. And so this is raising concerns by the RBI that there could be overhang of lot of unsecured personal loans and other loans, and this could have a stress in the financial markets. Globally, too, with the equity markets rallying, there's been a lot of interest in high yielding and private credits. And this is also causing a bit of concern among the investor community. Also, currency markets have been very volatile with the Japanese yen going to record lows. And again, this is with the and gold prices rising again to record highs. All are signs of stress at some levels, or just an investor concern and protection. So, if anything turns abnormal in any of these markets, then there could be financial stress. And if that happens, then there could be extreme volatility in all of the markets. And in this case, GSEX can benefit as well, following the US Treasury markets as well, because investors can pump money into 10-year US Treasuries, which are already down to below 4% from touching as high, from crossing 5% just a few months ago. Put together, there it does. There is definitely a sense that at the investor community level, that it is a good idea to protect part of the portfolio against market stress, as also capture any capital gains that could come out of interest rates fall over the next 1 year or 1.5 to 2 years by investing in GSEX, which can give you the best risk return profile in this current market conditions. So investing in G6 is made easy by INR bonds. All one needs to do is select the G6 they want to invest in and transfer the money to funds to the stock exchange for the G6 to come into the demat account. Log into INR bonds partner portal for the easiest way to transact in G6. Everybody, financial advisors and distributors and other intermediaries and investors should understand that G-Secs carry interest rate risk, while bonds do carry interest rate risks, credit risk, and liquidity risk. Thank you very much for listening in, and do follow us on podcast channels.